Imagine you're 20 years old. You don't work at Goldman Sachs. You don't have a Bloomberg terminal. You don't have millions of dollars. And you certainly don't have a team of Wall Street analysts watching the market for you. You have a laptop, a few $1,000s, and one simple idea. Then something unbelievable happens. You start beating professional investors, not once, not twice, but again and again. And the strategy isn't some secret algorithm developed by a hedge fund. It isn't artificial intelligence. It isn't insider information. It's incredibly simple. So simple that most traders would probably ignore it. But there's a catch. Because when a strategy looks too easy, the hardest part isn't discovering it. It's having the discipline to actually follow it. This is the story of the 20-year-old trader who decided to stop predicting the market and started waiting for it to tell him what to do. Part 1. The problem with Wall Street. Wall Street is built around information. Every day, thousands of professionals analyze earnings reports, economic data, interest rates, company guidance, analyst estimates, and breaking news. They have teams. They have technology. They have billions of dollars. And yet, there is one uncomfortable truth about investing. More information doesn't automatically mean better decisions. In fact, sometimes it's the opposite. The more information you consume, the more reasons you can find to change your mind. The market goes up. You think it's going higher. Then a headline appears. You become nervous. The market falls. Now you think the crash is coming. Then it rebounds. You buy. Then it falls again. For a young trader watching all of this, the market can feel impossible to understand. That's exactly where our story begins. A 20-year-old trader, let's call him Alex, became obsessed with one question. What if I stopped trying to predict the market? What if, instead of asking where the market was going tomorrow, he simply reacted to what it was already doing? That question changed everything. Part 2. The simple idea. Alex began studying historical market data. He wasn't looking for the perfect stock. He wasn't trying to find the next Apple. He wanted something much simpler, a repeatable system. Eventually, he came across a basic trend-following concept. The idea was almost embarrassingly simple. When the market is showing strength, stay invested. When the market shows sustained weakness, reduce exposure. That's it. No predictions, no emotional guesses, no trying to call the exact top, no trying to buy the exact bottom. Instead, the strategy used a long-term moving average as a simple signal. If the price remained above the trend line, Alex stayed with the market. If the market fell significantly below it, he became more defensive. It wasn't designed to predict crashes. It was designed to react to trends. And that distinction was incredibly important. Because predicting the future is nearly impossible. Reacting to what has already happened. That's much easier. Part 3. The first test. At first, Alex didn't trust the strategy. It looked too simple. So he tested it, then tested it again, and again. He went through years of historical market data. During strong bull markets, the strategy stayed invested. During prolonged downturns, it reduced exposure. But something interesting happened. The strategy wasn't perfect. It sometimes exited too early. Sometimes it entered too late. Sometimes the market dropped for a few weeks, recovered, and the strategy generated a false signal. But Alex noticed something important. It didn't need to be perfect. It only needed to protect him from the really big disasters. That's one of the most misunderstood ideas in trading. You don't need to win every trade. You need a system where your winners can outweigh your losers, and where one catastrophic loss doesn't destroy you. Alex started thinking differently. Instead of asking, "How much can I make?" he asked, "How much can I afford to lose?" That question would become the foundation of his strategy. Part 4. The psychological trap. But there was a problem. The strategy was easy on paper. Following it in real life was incredibly difficult. Imagine the market has been falling for weeks. Everyone around you is terrified. News channels are talking about recession. Social media is predicting a crash. Your friends are selling everything. And your strategy says, stay calm, follow the rules. Then imagine the opposite. The market has been rising for months. Stocks are making new highs. Everyone is getting rich. Your friends are bragging about their portfolios. You start feeling like you're missing out. And your system tells you to wait. This is where most people fail. Because investing isn't only a mathematical game, it's a psychological game. Humans hate losing. Humans hate missing out. And humans are terrible at staying emotionally neutral when money is involved. Alex realized that his biggest enemy wasn't Wall Street. It was himself. Part 5. The biggest test. Eventually, the strategy faced its real test. The market entered a period of extreme volatility. Prices were moving violently. One day, stocks were collapsing. The next day, they were exploding higher. Then they fell again. Investors were searching for answers. Was the bottom in? Was another crash coming? Nobody knew. But Alex had something most people didn't have. A rule. He didn't need to know what would happen tomorrow. He only needed to know what his system was telling him today. That discipline kept him from making emotional decisions. And that's where the strategy began to show its real power. Not because it predicted the future, but because it prevented Alex from repeatedly making the same emotional mistakes. He wasn't trying to become smarter than the market. He was trying to become more disciplined than himself. Part 6. Why it worked. So why can a simple strategy sometimes compete with much more complicated approaches? Because complexity isn't the same thing as effectiveness. A professional investor might analyze hundreds of variables, but if emotions cause that investor to panic at the worst possible moment, all that analysis can become irrelevant. Alex's strategy had 3 advantages. Number 1. It was systematic. The rules were decided before emotions entered the picture. Number 2. It focused on risk. Instead of constantly chasing the biggest possible return, Alex focused on avoiding devastating losses. And number 3. It was repeatable. He didn't need a new idea every morning. He didn't need to guess which stock would explode. He simply followed the same process. And that's the part Wall Street doesn't always make obvious. Sometimes the biggest advantage isn't having more information. It's having fewer decisions to make. Part 7. The lesson. Now, before outthink this story means there's a magical strategy that can beat the stock market forever, there's an important reality check. There isn't. Trend-following systems can produce losing trades. Moving averages can give false signals. Markets can behave differently in different periods. And past performance doesn't guarantee future results. The real lesson isn't that a 20-year-old discovered a secret formula. The lesson is much more powerful. He discovered that simplicity plus discipline can be more valuable than complexity without discipline. You don't have to predict every market move. You don't have to catch every rally. You don't have to buy the exact bottom. And you don't have to sell the exact top. Sometimes the goal is simply to stay in the game, because the stock market doesn't reward the person who makes the most predictions. It rewards the person who can survive long enough to let their strategy work. And that may be the biggest secret of all. The strategy wasn't really beating Wall Street. It was beating the trader's own emotions. And once Alex understood that, he stopped trying to outsmart the market. He started respecting it. If you enjoyed this story, subscribe for more true and fictionalized Wall Street-style trading stories, market mysteries, and the strategies behind some of the biggest wins and losses in financial history. And remember, the market doesn't care how confident you are. It only cares whether you're prepared.